Good day all. Ira Epstein of Linn Associates with your agriculture update, and this update is for Wednesday, and we're at the 20th of March 2019, just after 3 p.m. Central Daylight Time. So today was an interesting day. We saw an impromptu news conference with the president where he's keeping the tariffs, or threatening to, on China, even if they make a deal. That didn't sound right to me. I can't figure that one out, but the grain still managed to rally today. The Fed came out with their meeting, and the dot plot goes to zero for the rest of 2019, which is a bit of a surprise. It could have gone to zero, but the Fed really said they don't see anything until next year. Well, that put the dollar down sharply, gave a bid into some of the foreign currencies. You can't go by the pound, obviously, with Brexit and all the problems there, but even the yen got a heck of a boost on that. Energy prices higher, and what I think happens here, to a degree, is the lower U.S. dollar might be a bit of a boon to the metal markets, to the grain markets, to the softs. It can come into a number of different areas. When we look at where the weekly chart of closes on soybeans are at midweek, we're down 3 1/4 cents. Here we are trading very close to either side each day of that 18-week moving average of closes. I think the market is fighting its battle right there, and we'll see how that comes out. When we take a look at the daily chart, as you look at the chart formation, you almost see here waves to the downside, and here as well. In other words, lower highs. If this market were to get up and over the high right through here, and that high is 911.5, you could catch the market flat-footed for a little bit. And the reason would be you'd have that pattern of higher lows, then higher highs. In relation to key moving averages, that would be over the 18-day average of closes, putting into the target, and it's not that far away. The 100-day average at 916 3/4, only a nickel away from that. And the Bollinger Band, well, that's falling every day, and it's falling to the tune of anywhere from 2 to 3 cents a day. So it's probably going to get down to the 920 level tomorrow, 921, right in that zone. So I'll look at resistance in that area only if you clear this 911.5. What do I think the bears are trying to do? Well, temporarily, they may go to the sidelines. Why? Let's assume the market does not take out today's low. You could easily end up with a pattern of first lower highs and then higher lows. It could become a neutral moment for a while. The only way that I think the bears grab again control is taking out today's low in the market, and momentum is arguing that. You've got momentum flat to a little bit of an arc up. You came back and you're fighting the battle like we talk about so often. The line in the sand, the 18-day average of closes, 1, 2, 3, just about 4 days in a row now that you've been hitting that number and stalling against it as the market's looking for direction. When we come to the meal market, normally in the soy complex, I look for the meal to be the leader of the upside if you're going to lift soybeans with everything. Well, in this case, my dilemma is, even if the market takes out 312.30, the last high, I've got two pretty big layers of resistance here at the upper Bollinger Band, 313.30, and the 100-day average. Why are Bollinger Bands important? That's these black dashed lines. They're important because the market will stay within them 95% of the time. If you want to play that they're going to get out of it that 5% of the time, the way they did in hogs as an example, I wish you the best. The problem is you're not going to be right 95% of the time. That does not mean you get bearish here. It simply means that's where resistance comes in. When I look at soybean oil, the market now for 3 days has held the 100-day average of closes. At the same time, it has got what we call locked-in momentum that is bearish. I am still looking to see how the bears handle a rally, which they haven't had. And I would expect that they sell it fairly aggressively, actually. And if you take out 30.08 and you lose the embedded reading, well, then you lose that downtrend. But right now, that's very well entrenched in the market. In the corn market, the battleground is the 18-day average of closes. Notice there's a theme here that's going on. Another 4 days in a row of hitting that number. Either side of it not able to move off center one way or the other. If you take out 375.5, you would have a pattern of higher lows, higher highs, putting into play wherever this Bollinger top comes in tomorrow, and it's dropping about 2.5 cents a day, so it'd be 378.5. So what's my dilemma here? The dilemma is even if it takes that out, the first resistance is right on top of the market. That's difficult. Where I think the bears would try to take control of the market again is getting under 367 3/4 and trying to make the market drop to wherever that Bollinger Band is. The bottom band is only coming up about 1.5 cents a day right now. That can accelerate, but that's all that it's currently doing. In the wheat market, the trend, at least the attempt, is to turn the trend up. This is a seasonal time of the year where wheat often breaks, doesn't rally. And it does so until just about the end of the month. We've had a rally back where the market has fought for 1, 2, 3, 4 days in a row, again, fighting at this number. It got over the 464 level, which means what? It means the pattern has turned to higher lows, higher highs. The dilemma is you're overbought. So I'm looking at a market that, yes, it's saying maybe it can make an attempt at the upside in an overbought condition. Unless it embeds, I want no part of that as a trader. Can it turn bearish? Let's flip the story around. If you take out 453 3/4, you still would have a higher high, lower low. So the answer is the trend is up, the bias is up because you're over the 18-day average, momentum is up as a whole, but it's overbought. Sugar market, the 100-day average has become the break for the moment in this market. What do I mean by break? The resistance wall. So the market's come up there 3 days in a row, stalled out. Should the market take out 1264 and not get through 1287, you could end up with lower highs and lower lows, but you'd be over the 18-day average unless you close under 1254. You are overbought. In other words, you're using momentum to the upside and not going anywhere just yet. If it could clear the 1287 level, it could stay overbought as it makes a run to the upper Bollinger Band. Difficult trade again. In the coffee market, I would be very surprised if the bears aren't taking money off the table. Why? If you take a look, this market had a pattern of lower highs, lower lows. The key was not to take out 67.95, which was the outside day down on, I think that was Monday. Let's take a look. Yeah, Monday. So if the market goes down, what did we talk about yesterday? We said as long as the market doesn't get over that, and even if it did, the 18-day average is resistance, but you'd lose the pattern of lower highs, lower lows, you put into play the lower Bollinger Band. Today the market went to that number. The easy, maybe EASY or EAZY, which way do you want to spell it? The market, it's over. That doesn't mean you can't go lower. But when you hit these lower bands, you've had a tendency to give you a bounce. So I'd be a little bit cautious. Trend down, oversold. Cocoa market, trend down, lower highs, lower lows, but oversold. This is a pretty common theme that we're seeing right now in the softs. Getting to the oversold area, you might hit the 2130 area, but I think the pros will take money wherever that Bollinger Band in the morning off the table. In the cotton market, you are still in an uptrend. The market, as you can see, though, has got a situation where it's overbought. Both numbers are, well, one number's over 80, the other's over at 78. Any readings over 70 where both numbers don't lock in over 80 is just an overbought condition. Let's assume the market goes up, still in an overbought. Okay, the trend is up, the bias is up. Strong resistance, 76.36 to 46, the 100-day average upper Bollinger Band. Cattle market, been hitting and riding this upper Bollinger Band. Now you were over it today. Yesterday you were over it, that's 2 days. Day before you were over it, that's 3, and the day before, that's 4. I give the odds of staying over it about a percentage point tomorrow. 5% of the time the market stays over or under a Bollinger Band, right? I subtract 1 percentage point for each of those. The market normally then pulls back. But the fact that it's had 4 over it is a sign of strength, not a sign of weakness. So what I question is how well it gets supported on the pullbacks. You're in overbought territory. I think the pros are taking money off the table. In the feeder cattle, I think the same thing. And I realize the market broke out, but it broke out right here. We were talking about that. Is the market going to be able to run? It got up yesterday. Today you extended that run. So that's pretty important to the market. And the hog market, by the way, got back yesterday, right here by that Bollinger Band, as you can see. 1 day under. What did we say? You get these this one had 6 days in a row. That's just a sign of super strength. You even went as high as limit up today and closed there. That's powered. So what's going on is the market is still betting that short supply, a lot of export business is going to happen. It could be Mexico, it could be China, but this market broke out from down here. Very difficult to get involved. Now, if you're not in it, it's a hard market to want to chase because your risk is so large. I write about all this, and I put out written trade recommendations in addition to other research that I do throughout the day. As many of you know, I put out my morning video as one subscription. Some people want to take just my commentary, and we offer another subscription for that. And we have a third subscription that gives you my written commentary, written trade recommendations along with the videos. It all looks like this, and if you haven't tried it, I want to put it in your hands. At least give me a chance. You take a look and see if what I write or what I'm making sense out of or trying to makes any sense to you. And I'll be writing an awful lot. I've been putting it already together, talking about what the Fed did today, the impact of it, what I think it can do for the commodity markets, where it can do that. So if you'd like to see this, it's pretty simple. How do you get a free trial to it? And the word is free if you haven't tried it before. 866-973-2077. You can also go to our website, www.iraepstein.com. We'll put it in your hands. Just go there, sign up for everything. You'll see our carousel of free offers, and I'll be with you tomorrow.